and some of the basic stuff related to accounting. Now, the question is, why we have a different name, something added to the word accounting called intermediate accounting. And that's what we have to just clarify. We have already discussed this in the past class, but we'll begin with the clarification on how this nomenclature, it is there in your first lecture. So we'll just revise what is there. In the principles, basics of accounting, you were learning about the same things, but at the basic level. In intermediate accounting, you learn about some different, some advanced types of assets and liabilities, and those assets and liabilities, like four types of assets we discussed in the last class, like cash. So if the cash is there, how to account for them, plants and assets, receivables, inventories. So in the intermediate accounting, it is the accounting of some advanced types of items, assets and liabilities, etc. Also, in the last class, here is what was the most important lesson from the previous class. Was that, if we want to do accounting, if first thing is, we are clear now, all of us, that accounting in a very raw form, can be defined as recording. Okay, all of you, are now, must be, you are very clear about the fact that muhasaba or accounting means recording. And then the question will be recording of what? So it is the recording of financial transactions, in a business. It may be in a business firm or a non-business firm, wherever you have financial transaction, wherever you deal with money, where there is an income and expense, you do accounting. At individual level also, at the level of individual like us, we will have to do accounting if we have to pay taxes or zakah. For that matter, we do accounting. We have to record how much was our income, how much was our expense, what is the leftover, and then decide what will be the liability of tax or zakah on us. That is accounting at individual level. So we discussed how many elements are there in financial reporting. There are, basically, in the last class we discussed, there are 4 elements of financial reporting. And I am sure many of you will be remembering those 4 elements of financial reporting. What are those elements? Number 1 is the information, financial information. And in the assignment, that was what the main objective or the main idea of the assignment was. And I have gone through a few, but I'll give you a detailed remarks by Wednesday when I am through with the class for this week. The idea, I am sure, many of you understood it well, or some of you might not have understood why I am doing this. I received good queries from students. They were asking about should I present numbers or what? Tell me, So the idea was to explore information, not numbers. Numbers are just data. They don't tell anything. If I tell you my liquidity ratio is 3:1, now that doesn't tell anything. The question was, what information did you get? You got liquidity ratio or assets or liabilities. So that's what you had to I left you open to explore as much as possible, and the students who would have given written more information will get more marks. And that's what I'll see, whether you were able to find information from the reports or not. And as I said, you have to choose just one company. So I'm sure you chose one company, went to their websites. Now the question was, the reports or the financial information are not just available on websites, on the websites of the companies. You can also find them here and there. So it was all about searching also. So your job was to even search. And that, what makes you a business analyst, a person who has knowledge on the analysis of companies, who counsel, who give counseling to people where to invest, which companies are doing well. And that's the starting point. The assignment that you did was the starting point of becoming a business analyst or equity analyst. So the whole idea was to make you discover information on accounting. Basically, the reports are the results of accounting. So coming back, accounting is the recording of financial transactions. The elements of reporting, the report will be converted or will be derived from accounts. So the elements of financial reporting are: number one, information, financial information. So you have to understand, and you must have understood after doing the assignment, what is information, what is financial information, which is there in the public domain, which you have to present to the public, to the government and others, who are called the second element of financial reporting. What is the name of the second element of the financial reporting? Is the user groups. Economic entities are the institutions. They are the businesses who do some business, they do some transaction and make profits. They are supposed to do accounting. The third is the user group, who are the people who use financial reporting. One of the users are you. You were searching for the financial reports of the companies. That means you are the user. Students are the user. So you are a special type of user. The researchers, the scholars, or the analysts, they are also user of the financial information. The most important entity who wants to see the financial reports of the company are the owners. Okay, so user groups, they are the stakeholders. They may be the stakeholders of the company. Okay, so who are the stakeholders of a company? Who are the people who are interested, interested in knowing whether the companies are doing good or bad? They are the stakeholders. And when we say stakeholders, there are a list of stakeholders. I hope you all know about the stakeholders of a company, because when you do accounting, when we will be seeing the theory of accounting, these are the stakeholders who actually influence the system of accounting. So can you tell me who are the stakeholders of a company, of any company? Who is the main stakeholder of any company? That's not number one. Investor is number two. Who is number one? Who is the most whose stake is the most in any company? No. Shareholders and investors are the same. They are not different. They are the same. The owners, very good. The owners, and owners like Jeff Bezos of Amazon, or Bill Gates of Microsoft, or the Google owners, they are the people who have the first stake in any company. Mark Zuckerberg of Facebook. Okay, so they are the people whose stake are more than just investment. They have their emotional stake. They have their they are the owners of the firm. They have legal stake, because if they do anything wrong, they will be first be booked for any wrongdoing. See, owners are the number one stakeholder. Number two is investor or shareholder, as you said. Number three are employees. Number four, yeah, suppliers. Of course, suppliers would like to see your financial reports. They would like to see whether you are a good company, whether you pay on time or not, because this will be mentioned in your financial statements, whether you are paying on time or not. So suppliers, I hope you are noting down. Okay, so you keep noting down these stakeholders. They are important for financial reports. Number five. Number five, we had owner, investors, employees, suppliers. What else? Customers. Of course, there are customers also who would like to sometimes, not always. Like you are using some pen to write down, but you never go and check the financial report of that pen company. But yes, there are some companies for which you are interested in seeing the financial reports. And in big, like if I am going to buy a big airplane from Boeing, yeah, of course I will like to see the financial statements of Boeing also, so that I can be sure whether these people can make Boeing or not. So it depends. Customers are also stakeholders. Who else are the stakeholders? Competitors are also stakeholders. They do not have any direct stake in our business, but yes, they are always looking for the reports. They want to keep. They are some special type of a stakeholder. Customers and competitors are a special type of stakeholders. They are not directly investing in us. They do not lose if the company doesn't do well financially, but yes, they are stakeholders. Anyone else left out in these stakeholders? Excellent. Government. The government is also a stakeholder of any business, because they, first of all, legally they are liable to see that the business is legal, the business is not doing harm to any country, and the business is also submitting or depositing taxes on time. So that's, and the last stakeholder, in the most recent stakeholder in any business is, who are the latest ones? They are the stakeholders who have been added in any business, any company. You have to take care of this stakeholder. The creditors, no, yeah, okay, they are there, but who else? The companies today have to take care of them, and they have to invest money to take care, and they have become the latest stakeholder of any company. Employees done. That's over. I think you have already noted down employees. Who else is a stakeholder in businesses now? Because if you are running a factory and you are not taking care of the what environment. So environment has been added as a stakeholder for any company. So now the companies have to also take care of environment. They have to ensure that they don't pollute. They are not emitting bad gases. They are not emitting any pollutants in the environment. They are also taking care of trees, etc. So they have become a stakeholder in companies. But in traditional, from accounting purposes, because this environment is a virtual entity. They are not existing in. They are not human beings. They are something. They don't ask for financial reports. So, but still, as a student of business, you must know that these are the stakeholders of any company. Most important are owners, investors, employees, creditors, suppliers, the government. These are your most important stakeholders, and they are the user groups who use your financial information. And environment, as we discussed in the last class, is the legal, political environment, social environment, which also affect your financial reporting, how you should report. So as I said, there are many companies who make green reports. Now, green reports, obviously, as you hear the name green, what comes to your mind? Ecosystem, plants, trees. So now the companies are asked, as a moral obligation, they are asked to prepare green reports. They mention that they take care of the environment, they plant trees, they don't cut trees, etc. That is called social environment. So these environmental factors also affect financial reporting. This is called financial, these are the elements of financial reporting. Now moving ahead, I hope till here you don't have any doubt. And in the last lecture, there were some things which I discussed, but you have to read them, is the difference between the national and accounting standards. You have to know the names of the standards. So just to revise, the accounting system which is being applied across the world is one. All the companies of the world, good companies of the world, are trying to use the system of IFRS. So I hope you know the name, you know the full form of IFRS. That's something you have to learn before we move forward. IFRS is International Financial Reporting Standards, and there is a body called FASB. They make standards. They keep developing standards, and this is not only limited to United States of America, but they are also this standard is general. They are taking into account all the countries, all types of companies, and then developing these standards. Earlier, before the IFRS, United States used to have GAAP, the generally acceptable accounting principles, but GAAP was not used across the world. It was a local accounting standard, and all other countries were used to have their own standards. Like Saudi Arab, they were using their own standards. It was not linked to any international standard. So here in Saudi, we have a body called Saudi Organizations for Certified Professional Accountants, and SOCPA, they are responsible for SOCPA is responsible for taking care of developing standards, of instructing the companies to comply with the standards, and they also do training programs. They publish journals, etc. And there is a possibility that if you take initiative, we can in some way get in touch with SOCPA. I'll try to, and you will have to help me, both your sides and the boys' sides, if we can do something to get in touch with SOCPA so that they can help us in this course and later also in accounting, so that it becomes more practical learning for you. Okay, so the accounting standards, you have to know the names. That's number one is IFRS. GAAP is the older standard which was applied in USA, but it was also applied in some other countries. Why? You should know this. Why were countries in other companies in other countries were trying to make their accounting reporting reports as per US GAAP or some standards of UK, Europe? The reason was, I hope you are clear, getting me clearly. My voice is clear. The reason why the companies were started preparing their reports as per the US GAAP or European standards was because these markets, the stock markets of these countries were open for any company to come and sell their stocks. All right, so Almarai Corporation can if they wish, they can go to US stock market, New York Stock Exchange or Dow Jones, and they can sell their stock there in that market. So the investors are there in USA, Europe. They want to buy stocks, shares of other companies. What they did, these people, when they want to sell stocks in other countries, their shares in other countries, then they have to comply with their accounting standards. And being the most developed countries, they have the fully developed stock market, and now the companies from outside the countries, anywhere in the world, can go and sell stocks there, shares there. So when you want to go and sell your shares in USA or Europe, you have to, Almarai Corporation will have to prepare statements as per US GAAP or the UK standard or Germany standard. So that's why, and then there came the IFRS, which now is trying to unify. It's trying to make it uniform for all the companies in the world. They are taking into account several aspects of the companies in various parts of the world, and they have made the standards in a way that it can be applied anywhere. So now, if Saudi SOCPA is using IFRS, all the companies here are preparing their reports as per IFRS. So now the companies from USA can come and sell shares here, or these companies here can go and sell shares anywhere in the world. So it's like a common currency. It's like a common currency. So IFRS is becoming the latest standard of accounting. You have to learn that in detail. So if somebody from you have a special interest in learning about accounting, you want to make a career in accounting, start taking some courses in IFRS, and you will be seeing many courses, online courses, offline courses, which are offered to educate you on IFRS standards. And you can also take CFA, etc., to become a certified financial analyst, etc. So that's the second. So how many we learned? One is US GAAP, the second is IFRS. In Saudi, you have SOCPA. You go and check SOCPA and see what do they offer. And this next Sunday will be an off, so we'll see what assignment I should give you for the holiday. Okay, so SOCPA, and then there are in the Islamic countries and also in UK, UK, in Germany, in USA, in Canada, there are now parallel banking system, which is the Islamic banking system. So you find even the Standard Chartered Bank, they have a branch, a department for Islamic banking. The UK banks, Morgan Stanley, etc., they have all doing some form of Islamic banking. And in the Gulf countries and the Islamic countries, MENA region, Middle East and North Africa, Pakistan, Bangladesh, they all have, Indonesia, they all have Islamic banks. So when they became very big, it's now a very big industry. There was a need for a special type of accounting for Islamic financial institutions. So I hope if you have gone through the last lecture, you have seen that there is a body called AAOIFI in Bahrain, and they make standards based on IFRS again. Okay, they also are preparing standards for accounting for Islamic financial institutions. And if you want to learn about Islamic financial institutions accounting, you can just go download or buy a copy of the Sharia standards and the accounting standards for IFI, Islamic financial institutions, and you can become an expert in that field. And there is a big opportunity. There are lots of opportunities for students to specialize in accounting in Islamic financial institutions. Okay, so the 4 elements of reporting were the financial information, user groups, economic entities, and environment, legal, economic, political, social environment. Now, in the theory, which is more of a scholarly thing, not you don't have to do calculations or practical in theory. It develops from research. Theory is developed from research, and that's your second lecture. So that is your second chapter in the book, and it's important for us to understand the conceptual framework of accounting. So far in the first lecture, we were introducing some elements, definition of accounting, and why are we doing accounting? We were learning that. So now it's important for a student to learn about the theoretical framework of anything that you do, whether it is the behavior of consumers, or it is understanding of culture, or it is paying dividends to customers, to your shareholders. Anything that you do in your business life as a business manager or an entrepreneur, or for that matter, any practical that we do in any walk of the life, there is a theory behind it. So theory is something we are very familiar with, that if for every action there is a reaction. This is a theory given by Isaac Newton. So this way there are theory behind all the business transactions that we do, business decisions that we take. If you don't know theory, then your attending the college or classroom is a waste, because theories make you more defined. You are clear, what are the elements of your decision making. If you are taking, if you want to take loan, then you must have to decide, why do you want to take loan? Why not sell your shares in the market? So this decision comes from your accounting, okay, and there is a financial decision making theory also, but here suppose we link it with accounting. So you have an accounting system, you have a theory of accounting, you have the elements which are affecting your accounting system, and from there you decide that I want to take loan. So the main, there will be 6 goals, and this is directly taken from Pearson PowerPoint presentation. So as I told you, the book in PDF is not available, unfortunately. The book in PDF is of another author, and it is there on eLearn. I uploaded it there. You keep on reading the book, try to find these terms and items we are discussing in the class. But the main textbook is from Pearson, which is by Gordon. So that is not available online. So I will advise that you buy the book. And there is a week off. This is the best time to order and try to buy in bulk. Even if you don't want to buy 1 copy each, try to share it. Try to pull in money and then share the book, because you need to have book. It's one of the prizes of students, because when they pass out, they graduate. The books are very important. You will find it very important when you go and join a job. If you are really a good student, if you want to excel in your career, all good managers, they have done well in your classrooms, and then only they have excelled in their positions. So these slides are from Pearson, of the same book of Gordon that we are using, and I am using the slides, making some changes, and wherever required, adding my parts to make it simple or give you more information. But if you wish, any one of you, I can share you all the slides which are there with me for all the chapters. Though we are not covering all the chapters, we are covering only a few selected chapters from the book. But if you wish, I can share all the chapters slides with you. You can use them later. So there are 6 goals we want to achieve in this chapter. So the goals that we want to achieve here in this chapter are to understand the conceptual framework of accounting standard setting, how it is done. Is there any model that we do standard setting? The second is to define the objective of financial reporting. So this we have done partially in the introductory lecture, but we'll see it in this chapter. What are the objectives of financial reporting? The third is the qualitative characteristics of financial information. There is one is that when you will have, for your assignment, when you opened the websites, when you opened the reports, what came to you right in front of you would be numbers. And I think you all, I don't think there is anyone who, when they have opened the reports, would have seen text rather than numbers. All of them, all of you must have seen first numbers, and that's why students started asking me questions. Numbers, how many numbers we should write, what are the data we should give you. So financial information is about numbers, that means quantitative, but it is also about the qualitative characteristics that makes it better, that you should know what makes financial information. That is why I was trying to make you focus on information, not numbers. Information can be qualitative or quantitative. Information can be qualitative, it can be written in text, or the information can be, if I say you are number 2 in the class, that's fine, that's qualitative information. But if I give you a full remark, you are very good and you are good in this, etc., I write in words, that is qualitative information. So what we have to learn as a student, business student, is that we have to also see what makes the information good, what makes the information better. So we have to learn that if we are doing accounting, or we are the user of accounting information, we can tell the accounting manager of our company, see, you should do this to improve your performance. Number 4, we already know about the elements of financial reporting. We'll see it again. We'll try to see what are the elements and how they affect the reporting standards. Then we have to see there is a very important concept that we have to learn here in this chapter, is that there are 2 forms of accounting, 2 main types of accounting. And you remember in the last class we said accounting is recording of transactions. And when we said transactions meant income transaction or expense transaction. Now when we say income transaction, income can come from sales, income can also come from other sources, small income, but mainly it comes from sales. Now the question will be, how to report sales, because sometimes the sales revenue will not come immediately after selling your product. There will be a time lapse, receivables. How to capture the time lapse? That's the question. So there are 2 types of accounting. We will see that. That's the goal number 5. And the last one are the assumptions used in financial reporting. Assumptions are always there in any theory. Any theory can never be perfect. You say, if it is Newton's theory or Einstein's theory or anyone, or Hofstede theory of culture, the theories have some assumptions that make it a theory, that makes it a perfect theory. Without that assumption, the theories cannot be generalized to all walks of life. So these are the 6 learning goals of this chapter. We'll try to quickly now cover all of them and try to finish them today in this class itself. Okay, so first, when we are talking about the conceptual framework, we must know, that if you develop a new standard of accounting, like for example, you take up any item which is new. For example, the Facebook business model. Facebook business model is new. It was not there earlier. Why it is a new business model? The Facebook business model is unique. That's a new type of a business model. Why? Of course, they sell data, but that's what they don't tell. Okay, so if you if you search for business model of Facebook, there will be many results you will get on Google. But in the business model, they say that they don't sell data. So what else is their business model? What is the main business model? You understand business model, all of you? What do you understand by business model? Anyone? Facebook business model, Amazon business model, Saudi Airlines business model, Panda business model. Do you understand what is a business model? What is it? Okay, and anything else? Who, customers, what they sell, what else? How they sell, all right, okay. You are missing something more important here. These are fine, but there are something, new type of business. Okay. You take your time, you can search on your phones also, no problem. You take your time because business model is very important to understand before we understand the standards. So what is a business model? It's a plan, yeah, okay. Okay. Yes, yes, right. Is it visible to you, this one? Can you see this picture? Oh, okay. Can you read what is there on the slides screen? Is it visible to you? These. Anyway, I'll give you one suggestion. You do one thing. I'll copy this link to WhatsApp, and you can check it. Go and check business model canvas. Okay. Later, not now. Later, when we finish the class, go and check the business model canvas. CANVAS canvas. And that's very beautiful explanation of business model, and you will also see there the opportunity canvas for entrepreneurs. Now, in the business model canvas, it's a very detailed pictorial. You can see it in picture and very easy for you to understand. And if you can translate it in Arabic, all of them, one of you, make it good picture. Just translate the English to Arabic, then it and paste it there in your. Send me a photo and paste it in your classroom. That will be a very good learning for all the students of business, because in business model canvas you learn your entire program. And business model is about what? It's mainly if we say accounting perspective, it's mainly about how much cost is incurred when you make a product, and who are your customers, how do you sell to the customers, and how do you take the price of the products. How do you take the price of the products? I hope you all are you have heard about pricing, PRICING, pricing of the products. Where do you learn pricing? In which course? Product price, place, promotion, price, marketing. Yes. So you must have studied that there are different pricing methods. Somewhere the most normal pricing method is that you will sell the product and take money from the customer. But you must know as business students that there are many other forms of pricing, like space selling. Space selling, like for example, where do we sell space? Have you ever seen space is being sold for and getting money for the space? Like for example, the most common example will be the hoardings that you see on the roads. There are billboards, there are hoardings. That's a space. It may be owned by the government or by private person, but I sell that space, I take money. Then there can be pricing that I take the price in the form of subscriptions. I don't take you the money once, but I keep on taking the money on monthly basis or on annual basis. This is called subscription. This is also pricing. Let's forget that now and come to the Facebook business model. Now in the Facebook business model, what do? Their main source of revenue is not selling data. Their main source of revenue is or Google or Facebook. What is their main source of revenue? From ads. Excellent. So that's what you should know. Instead of you users, you are not paying anything. It's a free application. It's a free software. Facebook doesn't charge you anything. They don't take any money for you, although we are the users. But who do they get money from to run the business? It is the advertiser. And why do they advertise on Facebook? Because of the number of members, people on Facebook. The number of people have become so huge that the advertisers are able to reach to people very easily. And there are other benefits of using Facebook is that you can also define your market. So for example, I just want to reach females of the world. I want to sell a product to only females of the world. Then I have the option in Facebook. Facebook has given me an option to define my target market. So that's why, this is a special type of business model where the price comes not from the users, but from advertisers. So when we are talking about new standards, new type of businesses, and like Islamic finance, a new type of business for the world, because they knew banking with interest. Now for the last 40 years, there is banking. Though banking was there, but though that banking, which was developed in the modern world, did not take into account the interest-free banking. So when something of this sort happens, what will happen? What happened? When fire? Okay. So when something of this type happens, something new happens, we need to decide on a new standard. So when we define or develop accounting standards, we have to take into account 4 factors. The four factors are, so that's your lesson number 1. Okay, so you have to memorize the four factors of developing a financial standard. Or when, and we are not talking about report, we are talking about a standard. So a standard means how should I prepare the report. A standard means how should I prepare the report, how should I write the statement, how should I report the number. These are four. Number 1, the objectives of financial reporting. We should be clear, why are we making the report, for whom are we making the report. So that's the first thing. Why are we making the report? Are we making the report to increase our share price? We are making the report to sell the shares in the market. We are making the report to attract suppliers. So that's the first thing. We have to decide what is the objective of the report. Number 2, the qualitative characteristics of the information. What message is understood? That's what they are now talking about in the modern times, that it has to give the message. And we in the last class, you remember, we discussed about communication. Accounting, the reports are a form of communication. It's financial communication, information about finance. So here, the obvious thing is that it will be about numbers, but the question is, with the numbers, what message you are trying to pass across. So qualitative characteristics. Then the elements of the financial statements that will be affected by the new standard. So if I am calling Facebook business model, and I get all the money from advertisers, I don't get any money from the customers, how will I report it? Should I report it as customer? Where should I report it? Should I report it as a customer? Should I report it as advertiser, or what form? And when I use advertisers at the source of money for Facebook, how will this affect the financial statements? And I hope you all know financial statements by now. Financial statements, some of the common statements are balance sheets, or can you name some statements? Income and expenditure statement. What else? Profit and loss statements, cash flow statements. These are the most common statements, and this is the second class. I hope by the third class you should be remembering all the common forms of financial statements. The last one, which we have to consider while we develop a new standard, while we are developing a new standard. And as you know, this developing a new standard is not the job of a manager. We are a company, we have to just follow the standard. But since we are in the classroom, and some of you may get specialized, you may do research in accounting, or you go and become a part of WFI. There, it will become more useful for you, because you will have to practically develop standards. As a manager, I will have to use these standards. So in both ways, in classroom, we have to learn how these standards are developed. So these standards are developed on the basis of the objectives, the qualitative characteristics, the elements, and the costs and benefits of the new standard. Why are we going to develop a new standard? Is there any benefit for this or not? These are the four important considerations while we develop the accounting standard. Here, it's how the framework works and how it moves. So it starts all from the objective. Okay, so the first point for doing anything in the managerial framework or any decision making is to decide on the main objective. So objective of financial reporting is number 1. Then it goes to the qualitative characteristics, and you can note down there itself or highlight it that qualitative characteristics are the in the characteristics which are not in the form of numbers. They are in the form of text. They are in the form of message. But they can be two. Yes. Come please. Slower. Excuse me. ايش هذا؟
هذا موية شاي.
अच्छा
واحد شاي 20 ريال.
20 ريال لكن انا ما يبغى
ما
لا. So the thing is, first is objective. The second point to consider are the qualitative characteristics. And there are two characteristics. One is the main, that must be there, and the second is enhancing. Okay, so the enhancing characteristics are those which are not obligatory, but one has to follow. Then the elements of financial statements, what should be the components of the statements, what should be there in the balance sheet, what should be there in the income expenditure statement. Recognition of revenue and expenditure. That's a major point that we have discussed today. That's the most important that you have to understand. Rest of the things are more theoretical. How do we recognize the revenue and expenses? Then comes the constraints. Now, if you develop this standard, can you really implement it? Will the companies be able to write it in the form that is there or not? Financial reporting standards are then developed. Then once you have the financial reporting standard, it will be converted to the statements, and then statements will be checked whether they are able to fulfill the objectives or not. So this cycle you remember, along with the four objectives, four main elements of standard setting. Now coming to the objective. Now memorize this. You have to memorize this. So why we should have a financial report? The answer is not to guess, but just to memorize this, to provide financial reporting, financial information about the reporting entity. And this one also, if someone of you can translate in Arabic, then it will be very useful for, and that you should do in the group. You can just take the text from here and translate it there. Why? Now, what is the main objective of financial reporting? The main objective of financial reporting is to provide financial information. Financial information, underline it, about the reporting entity. Reporting entity means the business, the company, it may be Facebook or Marai or anyone that is useful. Useful is highlighted, it is in bold, to existing and potential investors, lenders, and other creditors. Now, question is, you all understand all the three terms. Investors are the people who spend in your money, who invest in your company. And investment is a term that means risk, isn't it? You all understand risk? Yeah, risk means what? What is a very basic layman definition of risk? Very basic. What do you understand by risk? As an investor, think on investor. I put money in a company. What will happen? I may lose all the money, or I may lose substantial portion of the money. My principal may go down. So investors come from investment, which is associated with risk. So that makes it a difficult decision for me as a person who has more money. You are also learning. You must have been being taught banking and financial institutions. So in the banking and financial institutions, you learn about investors and depositors. There are two types of people. Depositors are the people who just keep money in the bank. They don't lose. They don't have any risk to lose money. But investors are the people who take risk. And the risk is very basic risk. Although in the financial management, we can see a list of risks. There are financial risks. and there are courses on financial risk management in advanced master's level. But the risks, the basic risk is I will lose money. So if I lose money, that's a big loss. So how will I ensure that I don't lose money? Meaning risk management. How to ensure that I don't lose money as an investor? That's the risk management. So for that, one of the basic tools of risk management is to see the financial report of the company where I am going to invest. So investors are potential investors are one of the main elements who will use my financial information. Number two, lenders. You all understand lenders? Lenders, who are the lenders? Primary lenders. What do you get from lenders? In the form of what? Money is given by investors also, but lenders give you what? Loan. Yeah, excellent. Yeah, lenders give you loan. So if you have notebook or paper, just keep on writing these things: investors, risk, lenders, loan. Otherwise, we will forget what we are discussing. Although I am recording this lecture, so inshallah I'll put it on YouTube if everything goes on well. So lenders give you loan. Now, what is the risk for them again? Yeah, it won't be repaid. The same risk. I can lose money. I am a lender. I am a bank. I am the main, officially, it's the bank who lends. So when I lend, there can be a problem with the company. They are not making money. They are not able to sell the products. Their business model is not working well. They thought there are many companies in the world after Facebook. They tried the same thing, but they failed. And that's a lesson for you. You can. That's extra. Other outside class assignment for you, not to be considered. Find out how many companies failed when they followed Facebook. They failed because they thought they can also do the same thing, but they failed because they didn't find advertisers. So what happens if I give money to you as a loan to run your business, and at the end of the year or 2 years you come back and say, oh, I couldn't, my business model flopped. So what I do, I say, oh, I'm sorry, I'll be declared bankrupt. And then that happened in 2008 in USA, in the financial crisis of the European and America. What happened? People went bankrupt. They gave a lot of loan to the institutions who couldn't repay. The result was a big loss to the economy. Third one are the creditors, other creditors. Other creditors are those people like, they are external other than banks who give you money as loans. So this financial information helps in making decisions about providing resources to the entity, buying, selling, holding equity, debt instruments, etc. We will not touch the equity or debt instruments right here. That will come later. So if you want to learn about this now, you can always check, go and find out on Google, and if you have any doubt, you can ask me outside the class on the group. I'll be happy to explain equity and debt, etc. But what you have to remember is the objective of financial reporting, and all of you must memorize this definition, the objective of, because this time we are being asked by our department chairs to give you writing questions in exams, not just objective. Okay, so you should write, and that's why all these definitions you memorize. So I'll repeat it again and try to memorize it. To provide financial information about the reporting entity that is useful to existing and potential. Existing means who are there right now, and potential who are looking for investment, etc. Who are the people, investors, lenders, and other creditors in making decisions about providing resources to the entity. Are you getting what does entity mean here? What are we talking about entity? Which entity? The companies, excellent. The companies like Facebook or Amazon, Almarai, they want to take loan. Okay, so they have. If you want to take loan, make a good report and go and tell, go and share it with the public, with the investors, with the lenders. And then they will see, whether your information is qualitatively and quantitatively good or not. Then they will give you money. So we move forward. We move forward to the next. This is a pictorial framework of what we have discussed, and try to memorize this also. And whenever some picture comes, why don't we share on the group so that it becomes a learning tool for us. Anytime, walking here and there, we can memorize the pictures as well as some major definitions from the class. Okay, so this is what we have discussed in the objectives of financial reporting. Number one is the qualitative characteristic. Now, qualitative characteristics are two. One is the basic, fundamental, primary characteristic, and the other is voluntary enhancing, which if you do will help to increase the quality of your report. But if you don't do it, it's okay, it's fine. But you will like to make your report better and better so that the three entities who give you money, who are the three entities? Who are the three entities we just discussed? The investors, the lenders, and other creditors. These people, when they give you money, they will be more comfortable, more happy giving you money if you follow the both primary as well as enhancing characteristics. Then comes the elements of financial reporting. There are two elements that is coming after this. Like after this slide, it will be coming. The elements are point in time elements and period of time elements. So we will see what is point in time elements and period of time elements. That is the second objective of financial reporting. We should ensure that we are able to correctly present the elements of financial reporting. Also, the principles of recognition and measurement. Now, recognition of what? Recognition of income and expenses. So we'll have to learn, when we are talking about the conceptual framework, the objective of financial reporting, we'll have to learn about the recognition principles and how, once we follow one principle, how the item can be measured. So if we are saying sales, and using one principle, then the measurement will be followed accordingly. So these are the three main objectives of financial reporting: to understand the qualitative characteristics, to understand the elements, and to understand the principles of recognition. In the qualitative, we have to learn what are the fundamental characteristics, what are these secondary or enhancing characteristics. In the elements of financial reporting, we have to learn about point in time elements or period of time elements. Then we have to learn about the principles of recognition. That will complete this chapter basically. Now the qualitative characteristics. Now the qualitative characteristics are based on mainly two main features. How do you say that your report is very good? On the basis of relevance, and the second one is faithful representation. Faithful representation is a very typical word, and you will deal with it in a better way in business ethics, your course on ikhlaqiyat idarat al-amal. Because faithful representation is what that you are honest as a company. You are honest. You are doing everything as per ethics, not just law. Ethics. Law and ethics are two different things. Qanun and ikhlaqiyat are two different. Do you agree or not? Law and ethics are different or same? Which is a must? Law or ethics? Law is a must, because if you don't follow law, what will happen? You will land up in troubles. But ethics is something which we do to ensure that we are honest. We say that we are an honest company. We always give you figures more than what is required by law. So faithful representation means that your reports are complete, they are neutral. Neutral is a term. These are all, you have to do your own study. Think on it. These are all points to think, and you will think more in ethics than here. And it's difficult to take up. I'll try to take up any case study in this course which is related to accounting ethics, because that's very important for you to learn. Neutral. You understand neutral? What does it mean? Can you think of neutrality in accounting? Think on it. Tell me, how can you be neutral? You are an accountant of a company, and what should be there that you are neutral? How can I know that you are a neutral person, neutral accountant? Are you all thinking or sleeping? Neutral, what is neutral? Neutral means I am an accountant. My job is to report correctly the financial condition, and I have to record transactions. I have to report the profit and loss, and that is a very tricky thing, to report what? Profit or loss? Report losses. And you will see that there are many cases of companies where they reported wrong profits. One of them, if I am not wrong, you can check it, is Zen mobile phones. The Zen is actually not a primarily Saudi company, isn't it? Zen is Etisalat, right? And do you know Zen Telecom? Is it a? Yeah, it's not basically a Saudi company. It's from UAE, right? I'm not sure. It's Mobily or Zen. One of the companies. What they did 2 or 3 years ago. It was this report is published. You can find it online. The financial fraud, accounting scandal of one of these two companies. It's not STC. It's either Mobily or Zen. They reported wrong profits for the company, and that's what an accountant should not be. An accountant must report correct profit and loss. So if you are reporting correctly profit and losses, you are a neutral accountant. But it's very difficult to be, because there are many cases where your boss, you are an accountant, very honest accountant, but your boss, he sees or she sees that there is a loss for the company this year. So she will ask you, do one thing, remove this cost or increase the sales. Then what will happen? Artificially, your loss will go and profit will come. But that is dishonest. That is wrong. That is not natural. You are cheating the investors. You are doing wrong. Maybe, there is a possibility that you are taking receivables now and making profit. But whatever you are doing, if you are not following the standards, you are manipulating the standards and making profit, then that is not faithful representation. So as a good accountant, I should be neutral. And then also, I should ensure that my statements are free from errors. It is possible. Error and fraud are two different things. Another ethical issue in accounting. There is something called error and there is something called fraud. Error is by mistake. I didn't know how to report sales. And then what happened? The result was that instead of loss, I reported profits. So that's an error, but error resulted in cheating of the customers or the investors. So I have to ensure that it's error free also. And that is why all the reports of good companies, of the listed companies, have to be in 1 year. What is to be done of the reports? Last time we have seen it in the last lecture. There is something called internal And every year you have to do it external. What is the name? What is the name for checking of all the reports every year of every company? Huh? I heard one correct word from somewhere. No, no, not annual reports. It's from A, but the correct word is every year, every huh? Excellent. Yes, auditing. So every company, every year must do auditing. And this auditing will ensure, that is why, the government, the law asks all the companies who are listed to do auditing mandatorily. Every year you have to do auditing, because auditing will check both. Auditing will check neutrality also, that there is nothing called fraud in your statements, and also will check errors. But surprisingly, that's how human laws are. Sometimes there are many cases you will see the auditors also are not neutral. So they take bribe or take money from the company, and they give fake certificates, as in the case of Enron Corporation. And others also are there. But Enron is a big game. Enron Corporation was a big name in frauds, where the auditor also connived. Auditor also helped in the fraud. So auditor just passed all the false reports. So these are two main features of the financial information, which will make your information qualitatively good and obviously quantitatively also. So what are the two main features? Relevance and faithful representation. You will remember this. You understood relevance? Relevance, yani your information is good enough to give a good picture of the company, whether the company is good or bad, and also it is ethically right. It's ethically good also. So relevance and faithful representation. Now, before we move forward, let us keep on revising the objective framework, the conceptual framework of financial reporting. The picture that we just saw, and I am sure you must have copied it on the group so that everybody keeps on revising this. There are three objectives of financial reporting: qualitative characteristics, elements of financial reporting, and the third is recognition and measurement. So when I say qualitative characteristics, we are discussing qualitative characteristics right now. There are two types. One is fundamental characteristic, and the other is enhancing. The elements of financial reporting are two. One is point in time elements, and the other is period of time elements. And the last one, the recognition principles, are two. One is the recognition principles, and the other important element is the basis for measurement. So all these, there are total 9 terms. You have to remember 9 terms. What are those? See here again. Look here. All these 9 you have to remember. Okay, so when we are trying to complete the conceptual framework of reporting, of accounting, you should remember this picture. And you see there are 3 elements, 3 objectives. Of all the 3 objectives, there are 2 each elements. We keep on revising this, and by the end of the class, if possible, we'll try to cover today itself. I think it's not possible now. So we'll just complete qualitative characteristics. Next day we'll complete the rest. Okay, so here is an example, the qualitative characteristics of financial information. Now, qualitative characteristics are 2. What are the 2 qualitative characteristics? Number 1 is relevance, and the other, second, is faithful representation. Now, here is an example of a Johnson and Johnson company. This is a financial statement. And you can see, and that's what I was expecting from you in the assignment, that you can find these also from the website or other places. You see, this is a qualitative information. It's not all numbers. What is this? This is a note. This is there in the annual report of the company. And you see this is note 4, property, plant and equipment. Okay, understand this very well and try to remember always that there are many other information in the annual report or related to finance of a company which you can find on the websites, on other places. So here in the annual report, you see it's written exhibit 2.4. It's in your book in Gordon. Johnson and Johnson property, plant and equipment, note excerpt. Note excerpt December 29, 2013 financial statements. Then what you are seeing in the picture in the box is what is present in the annual report. Note 4. It is given as note in the annual report. Property, plant and equipment at the end of 2013 and 2012. Property, plant and equipment at cost and accumulated depreciation were. Now this is informing the report the users in detail about the property, plant and equipment. What is it? Is it an asset or liability? Yeah, of course, this is an asset. So you see, that is why we are, in the intermediate accounting, we are trying to learn in advanced way. So here, the property, plant, and equipment are being recorded as them in a note. Something more is provided, that the depreciation is given, and depreciation is a very typical feature of assets, fixed assets. Every year the value goes down. That's an asset, but there can be exceptions also. There may be some assets, fixed assets, where the value may go up also. So we'll have to learn about them also. Now you see land and land improvements. Right now, don't bother about the numbers, etc. Try to understand, just see what are there in this note. Buildings and building equipment, machinery and equipments, construction in progress. That maybe in the company Johnson and Johnson, some construction is going on. So that is also reported. So in total, the property, plant and equipment gross. Gross is a term which you should be familiar with, and you should familiarize yourself. GROSS, gross, and net, NET, net. Gross, you know what? Gross is without any deductions. Yes, without any less, without any reductions. So when I calculate the total value of property, plant and equipment, it is $37,133. I hope this is just dollars. No, it's in million dollars, right? And in 2012 it was 34,654. Now they are adding depreciation. Now as when we become accountants, professional accountants, then we will learn how to calculate depreciation. Here it's just given accumulated depreciation, which is coming from the past year. This you have to reduce, you have to minus from the main figure, main cost, main value of property, plant and equipment, and then finally you get. So this is a qualitative information of financial report. This is an example of qualitative information. The last one, the last that we will discuss today, and then we will complete this in the next class, and I'll give you the next chapter, but we will start the next chapter only after we complete from here, because time is up now. What are the enhancing characteristics? So the enhancing characteristics of financial information are comparability. You can compare entities for capital allocation decisions. So there can be some scenarios where you can help the investors decide which scenario will be better, what happens if this happens. So comparability means that you give some comparisons to the users, which is not must. It's not important to give comparisons, but it's better to give comparisons to the investors or lenders or creditors. Secondly, verifiability. The the qualitative characteristic of financial information, which is enhancing, which is not a must, is that is there any way the amount that you are writing in your reports can be verified by the users? So if it can be verified, it's good. It's better for it's more ethical, better for you to give verifiable information. Number three, timeliness. Uh, Although every company is given a time frame that after within this time frame you have to give your financial report, annual financial report, but it's always good, all good companies will try to disclose their financial information much in advance, much in time, so that if I am an investor or a creditor or a lender, I am able to take decisions quickly, I am able to take decisions in time. So timely disclosure of financial report is also an enhancing characteristic. So you get time of 3 months. Sometimes if you have to report in March, you get time till June to give your financial information. But all good companies, it's a standard practice. That's what you have to learn, best practices of companies. It is important that you close your accounts by the year end and make the statements available to the public well in time, and that's a trait of good company. And the last one, the enhancing characteristic is understandability. Like for example, we just saw, this previous example, how they are explaining everything. You should not hide. The good thing that is transparency. You should not hide, you should disclose. So understandability is you have to classify the elements of the financial statements. You have to show them one by one and explain it in a good way to the stakeholders, to the users. These are the four enhancing characteristics. These are theoretical, these are you have to memorize, and you may not directly use it now, because in the accounting you will be just writing numbers, recording here, there. These will be useful when you take up managerial positions and you are practically making reports at higher levels. When you go up, you will see that makes you a better company if you are following these characteristics, the fundamental and the enhancing characteristics. Let's go back to this picture and we will stop. And then after, what about your attendance? Has it been done? Okay, so overview of the conceptual framework. You should keep on till the next class when we complete this chapter. You should remember this. What is the objective of financial reporting? So these are the three main objectives. Within these three, you have two further. I stop here. If you have any question, you can ask me now. Since next week there will be no class, so you can take your time reading, buying book. Do you have any question? Okay.